FOMC's renewed dot plot and Fed Chair Powell's impactful speech. Yesterday, the cooler-than-expected inflation data refurbished bullish optimism for equities. However, all three major indices gave back most of their gains at the end of the session as cautiousness resurfaced. In this report, we aim to present the recent fundamental and economic news releases that impacted the US stock markets, look ahead at the upcoming events that could affect their performance, and conclude with a technical analysis. Yesterday, the headline US Consumer Price Index showcased that inflationary pressures within the US economy have eased further in November, extending their fall since their peak. More specifically, the headline year-on-year CPI rate slowed to 7.1%, below estimates for only an easing to 7.3%. The month-on-month CPI rate also dropped to 0.1%, also recording a smaller than expected rise when compared to the 0.3% of market expectation. Moreover, the core CPI readings, which exclude volatile food and energy prices, recorded similar drops, with the month-on-month figure easing to the 0.2%, and the year-on-year rate fell to 6.0% compared to 0.3% and 6.1%, respectively, in regards to market expectations. The better-than-expected results put excessive pressure on the US dollar, knocking it back down to levels once seen before in June of 2022. Conversely, US stock markets positively apprehended the results, and equity traders found renewed optimism as the results solidified the view that the Fed would proceed with the 50 basis point hike as widely anticipated. All three major US indices, namely the Dow Jones, S&P 500 and Nasdaq 100, upshot at the time of the release. Yet, paradoxically, all three paired most of their gains and closed in the greens marginally higher. The move may signal that even though the results are favorable, market participants opted downside their bets ahead of today's Fed meeting decision, which may hold a surprise for them. The rationale behind such hesitation may be the fact that even though inflationary pressures eased further, they still remain well above the Fed's inflation target of 2%, implying that the Fed will need to act for longer, albeit with smaller hike increases to get it under control. Should the Fed, on the other hand, lean more towards the hawkish side, equity traders may be in for an unpleasant surprise. Later today, the Fed is scheduled to announce its last interest rate decision of the year. The central bank is expected to deliver a 50 basis point hike in this December meeting, raising the Fed's target rate to 4.5%. In 2022 alone, the committee has raised interest rates with the fastest pace ever recorded, hiking by a total of 4.25% basis point from April to this day. It's an attempt to bring persistently elevated inflationary pressures back to its 2% target. On the inflationary front, yesterday the November CPI print pointed to a cooling of inflation, signaling to the market that inflationary pressures have further subsided from their peak. The Fed's funds futures currently imply a 97% probability for the 50 basis point hike scenario to materialize, and market participants appear convinced that the committee will downshift from their fourth straight 75 basis point hike streak. Hence, the market looks past the decision and actively seeks out for the contents of the Fed's forward guidance contained within the FOMC statement. The renewed dot plot, which will shed light on where the bank's officials see the terminal rate being in a year's time, as well as the highly anticipated speech by Fed Chair Powell following the decision. More specifically, a large portion of the market currently forecasts that the Fed's terminal rate will peak at around 5% by the end of the first quarter and will start to fall as the central bank pivots and starts cutting rates near the end of the second quarter, since the estimate that inflationary pressures will abate and fall closer to the bank's target range of 2%. Hence, the dot plot is believed to possess the most critical details of today's event. Furthermore, also important will be the vote count from FOMC members, which should indicate a severe split among its members. There might be signs that the bank is facing internal problems and may pose as a credibility concern in the eyes of the market. Overall, the decision is expected to put more pressure on the dollar and, as a consequence, provide support for the US stock markets due to their inherent negative correlation. Thank you for watching.